Okay, I think we can get going, and I just switched on the live stream as well on YouTube. So hi everybody, thanks for joining in. We have Sonam back with us again. This time we've done a session with her earlier some months ago, and now she's agreed to join us again. And so today we basically want to have a free-flowing discussion on what's been happening in the US markets, how do they compare to the India markets, what is the future outlook of the market? How can you think about creating a portfolio in such a market? The goal is to help you make better investment decisions. Of course, none of this is to be considered investment advice. And so for us, we're basically trying to give you as much information as possible so that you can become better global investors, right? So that's what we have in mind. And a quick introduction on Sonam. She runs Right Research, and Right Research is basically an advisory platform that has provided one of our new vests. So we've launched a US portfolio with them that has been one of the most in-demand portfolios on the platform. It's a vest. We call it a vest, right? So they have launched one of them with us, and it's a very interesting one. We'll talk about the vest as well along the way. But just to kick things off, Sonam, first sort of question for you. Actually, before I head into the first question, quick thing, we'll also be taking a question. So if you have any questions, please drop them in the chat, and I'll sort of weave them in as we go. Either I or Sonam, either of us can answer them, right? So, okay. So firstly, thanks for taking the time out, Sonam, and joining us.
Thank you Viral, for having me.
Yeah. And so to kick things off, Sonam, what are your thoughts on the current status of the US and the global markets, right? There has been a lot that has been happening over the last few months. Of course, we've all heard about high inflation. We've all heard about how interest rates are increasing, the Fed increasing interest rates.
Right.
What is your take on the overall macro environment today in terms of the global markets?
Right. So I think we got one of our best macro news last week when the inflation in the US eased more than it was expected, and now in India also it has eased more than it was expected, and it's an excellent news, right? And it is sort of a news that tells us that the tide is turning towards inflation easing now, and maybe sooner rather than later we will see the Federal Reserve stop raising the rate, right? And I think that's the whole thing. When the Fed hikes the rate, everybody just rushes towards the US debt and the US dollar, right? That's why equities have been losing out. So I think as soon as there's more clarity on the Fed stance that they are becoming dovish from where they are, I think that would be a great news for the global market. And as we would have seen, we have seen in the last few sessions that global markets have been recovering in the Indian markets right now, right? Because they have been at a bottom for quite a long time, and now over the past 1 month, US, Europe both have sort of picked up a pace at a much higher rate than the Indian market, and that might continue because these indices are actually undervalued, right? So I think so that's a great news coming out from the US. If you look at, let's say, China is going through, they have stopped the COVID restrictions a little bit, but they're struggling with another side of the picture, which is deflation, right? Where the prices are going down much higher than expected, and that is making debt very expensive and is causing trouble in the economy. But yeah, I think we're getting early signs of things getting better, at least in the US. So I'm excited about the US equity piece right now.
Got it. And from you sort of talked about it briefly, from a valuations perspective, do you think that they've come down significantly from the peak? Do you think that there's still opportunity for it to go down further, or do you think it's in a range that is something that would make it attractive in terms of the US markets?
Yeah, I think the US market is quite undervalued compared to its historical averages right now, right? And I think there's a lot of scope for recovery from here. But yeah, the whole confusion or the whole question is, when the Fed rate hikes sort of stop, right? Because that's the whole thing that's driving this thing. So I think we saw a correction today and yesterday, right? We're seeing a correction in the US market because people are still not very sure about what the Fed is going to do, right? I think that's the whole thing. But I think there's a lot of scope of growth. And if you look at compare the US market with India or any other large market, you see that it is severely undervalued right now, and it has a scope of growth from these levels, right?
Got it. And from an India perspective, just if you could talk a little bit more about the India markets. I mean, people have been saying that the India market has been resilient throughout this, but also at the same time, what has happened is, I mean, the rupee is also depreciated quite a bit, right? So if you look at it from a dollar perspective, the returns that the India markets have given are not that attractive as well. So
yes.
What are your thoughts on that?
Yeah, I think see, see, the thing is that when the Fed hikes rate, it is like an avalanche that happens towards the dollar, the avalanche that goes towards the US debt, right? So no other asset class is favorable. So it is very interesting that India has continued to stay relatively robust, right? Even though on a dollar-adjusted term, it is not at par, but it has been robust, and that speaks a lot about the strength of the Indian economy and the growth prospects that India has, right? It has one of the highest growth prospects across the world right now, right? In the next few years and next decade, which I am really, bullish on, that India will continue to have the most highest growth, even better than China or other emerging markets in the next decade. It makes it very attractive. But, again, if everybody is moving away from risk assets, then, it is difficult for them to come back to India, right? So it will be a function of what is happening in the bigger picture with the US Fed and the rate hikes. Right?
Got it. And in the US, of course, there's also been talks of recessions and slowing GDP growth, and that having an impact on company earnings, and that in turn impacting the stock price, right? So would you suggest, like, one, what are your thoughts on that, like these entire recessionary fears? And then how, as a stock market investor, do you navigate this? Do you try to sort of time it and say, okay, I'm going to wait, or do you rather just continue to invest in your whatever your thesis is?
Right. So if you look at it technically, we are in US market is still in a recession, right? Given that they have seen 2 quarters of negative growth, right? Theoretically, they are in recession, and I see recession doesn't mean that there will be a crash and everything will go down, right? Recession means that growth is slowing down, and which is as we all know, that the US Fed itself has decided, right, that they are going to slow down the growth to make inflation go away, right? They think that if the growth rate keeps up going at a very fast pace, then there's no way for them to control inflation in the economy, right? So that's the fight that they are fighting. So I think, when you listen to Jerome Powell in each of his speeches, he comes out and he says that, we are going to bring down growth to prioritize the inflation thing, right? So, growth might be affected, but still, even in this economy, in this scenario, we have a lot of opportunities out there, right? It's not only about US tech stocks, which have been in trouble, but there's so many other industries and sectors in the US globally, which are very attractive right now, right? So it's, there are a lot of opportunities even in current scenario, and I think things will start looking up from here, right?
Yeah. I think one of the things that we see customers do on the platform is over-index on kind of tech stocks. And if you see this entire current cycle has given a lot of different opportunities. Energy stocks have been doing really well. Some commodities have been doing very well, right? So I think one takeaway definitely for folks is to look at other sectors as well, right? Not just because tech is always in the news. That's why it tends to take mind share, but worth looking at a bunch of different sectors as well before investing.
Right.
Got it. And so sort of we got a quick overview on what's the macro situation in terms of how to navigate this as an investor, right? So one, we talked about, okay, don't focus, especially in the US markets, don't over focus on tech stocks particularly, because that's sort of putting all your eggs in that tech basket, right? And which you don't want to do.
Right.
What are other practices that you might suggest to an investor? One of the common ones that I keep hearing is, I'm going to sit on cash for some time now because the markets are volatile, and then come in the timing is right. But what are your thoughts on doing something like that?
So I don't, I don't agree with sitting on cash, and especially when you are looking at the US market, right? There are so many opportunities, right? If you look at the global market, cash is just one instrument. There's so many other instruments that you could prioritize over cash, right? If you were to move to a slightly lower risk, right? So you can go to debt, you can go to dividend yielding stocks, you can go to some of the some value stocks. And there's certain commodity stocks that are doing really well right now, right? So even if you look at our vest that we have on the platform, you will see that we do have allocation to a bunch of sectors that have continued to do well, which includes your healthcare, dividend, value, etc., right? And some commodities, right? So there's so many opportunities, and when you are in the US market, you have instruments that are not just following US debt or US equities and US sectors. You have instruments that are following Europe, that are following China, that are following a bunch of other geographies, right? So which makes it very interesting.
Got it. So I think overall, just picking asset classes that are not correlated to each other, right? Like not over indexing on US equities alone as well is something that you.
I think we are not in the time right now where you just chase the FANG stocks and that is what you understand what global investing is. I think there's so many things to do, so many other opportunities, and that is why we sort of really like the US market as well, right? Because of the bunch of opportunities that it presents.
Got it. If anybody has questions, keep sharing them. You can either ask in the Q&A or in the chat. And folks that are watching on YouTube as well, please, if you have any questions, please share them. Would love to would love to answer them. Cool. So in terms of sort of creating the vest, right? You spoke about your thinking behind it. Can you walk us in a little bit more detail in terms of, okay, what was the thinking behind the vest that you created, and then I'll pull up the different instruments you have in them, and maybe we could just walk through them in terms of, okay, what's the thinking behind it? Not the exact allocation, but like what are the different instrument choices that we have made, right? So, but first, if you could just give some insight into the right tactical vest, what was the thinking behind it?
Yeah, so right tactical vest is, I think, like if you look at the global market, if you look at the global investment managers, right? What the majority of investment managers in the US are doing is they just create portfolios out of the ETFs that are present, right? US market is a market where, you have more volume in ETFs compared to stocks right now, right? And it's a massive market for ETFs following every given theme that you can think of, not like India where, you just have an index fund or like a bond fund. There you have ETFs chasing sectors, ETFs chasing themes, factors, new industries, innovation. There's so many opportunities in the ETF market, and then you have all the global things covered with Europe focused ETFs, Asia focused ETFs, emerging ETFs. Not just equity but equity, bond, even sectoral, right? So using these instruments to create a portfolio is very interesting. It is a truly tactical portfolio where you are picking up opportunities all over the world. And what is working, and you're trying to allocate to that. And I actually used to do this for a US-based investment advisor before I started right? So it has been close to my heart. I used to, this used to be my primary job out there. And, that was thinking behind it to, take out this product and bring it out to the Indian audiences as well through West.
That's awesome. Yeah, I mean, very, very glad that we got an opportunity to do that. Let me pull up the allocation chart that we have here, and to start with, if you could just explain what does tactical mean? Like, why what's the reason behind sort of picking, let's say, right tactical as the portfolio?
Right. So see, the thing is that there's so many opportunities, like I said, right, all over the market, right? There's so many opportunities you can see there's so many different sorts of ETFs that are included in this particular list, right? But and we have seen that innovation is something that works really well at certain point in time, and then we've seen sometimes clean energy do really well, sustainable energy do really well, and then there are other times when FANG stocks have picked up. There are other times when let's say nothing works, but let's say only the debt funds, right? So the thing is that in the market you can't have a buy and hold approach and expect it to give you that edge, right? You have to be tactical in the sense that you have to observe the market, what's working, what's not working, how the outlook is looking, and accordingly shift your allocations to the appropriate theme. And when we use ETFs, right, these are already very, very diversified products, right? And they bring out the essence of a particular theme or a sector that you have picked up. So that is why we have included instruments in our portfolios. And we are trying to be tactically, so like we have made quite a few changes in this particular basket over the years. I think we have reduced some technology exposure, some semiconductor exposure, some growth exposure over the past few months because of how the market has moved, and we have added value and dividend and large cap ETFs to counter that. And I think that's what our approach is, that we tactically shift to what we think is going to work and what is suitable for the current market scenario.
Got it. So two sort of actually three. The first kind of unique factor is that this is a full ETF only portfolio, right? No picking individual stocks and taking bets on stocks, right?
Yes, this is purely ETF portfolio.
Got it. And then the second is that it's also sort of relooked or rebalanced that on a monthly basis. So like you said, let's say semiconductors is a sector that goes out of favor, then you take that out and add, let's say, a dividend ETF, which is giving you basically free cash flow businesses that are giving out sort of high yields, right? That's another feature of this portfolio. And I think the third one is that it's diversified across industries as well as geographies. Is that correct?
Right. So see, so the tactical methodology works really well when you have like a set of diverse instruments, right? Things that don't move together, right? So if you look at the basket that we have, it contains so many themes that are moving in different directions. And when you create a basket of these instruments, you have a truly diversified basket that can give you a long-term outperformance, do well not just in good times but bad times as well, right? And obviously it's a function of what is going. I mean, a lot of assets are linked to the risk in the market, so you will see some volatility in this as well. But on the long term, it is a very well diversified basket, tactically allocating to what is going on in the market.
Got it. Is there, in terms of, I see there are two value ETFs, right? Like, what would the thinking behind, is that sort of because of the current market conditions to look at value ETFs and value investing?
Yeah, so see, our methodology is purely, algorithm driven with this, right? So what we do is, as a first step, we have sort of taken a set of ETFs that we want to work with, right? So we have taken out, ETFs that are liquid, ETFs, that represent that particular industry or sector well, right? And we have reduced any ETFs that are very, very correlated, right here. And then we just run our tactical algorithm, which is optimization weight algorithm, which is trying to give you the best performance for the current market scenario, looking at the risk in the market, trying to reduce the risk while giving exposure to the best performing assets. And through that algorithm, we have got allocation in two value ETFs, which is fair, because I think if you look at the performance of these value ETFs, you see that these are the ones that have really outperformed, right?
Got it. There's some real estate exposure as well, which is interesting, and again a sort of an uncorrelated asset class to add.
Yes, and it has been picking up pace over the past few.
Correct. From a returns perspective, how should somebody think about this one? I'm like, should an investor think about this in terms of, okay, I will get let's say, I mean, I should compare this to the S&P 500 and measure whether I get more or less? Or is there an additional sort of risk component that they should think of, because this is much more diversified, it's lesser risk, and so it's okay if it doesn't track the S&P closely, but overall I'm reducing the risk in my portfolio.
Right. Yeah. You're absolutely right here. The exact benchmark for this is not S&P 500, because we do have a much different, a very different exposure, right? It's not just the US equities, but a bunch of other things. So yeah, it is. See, the approach here is that we want it to be performing well in any given market scenario, right? That's the whole thing, that we're tactically picking up the best instruments for any given market scenario, and that is what we're trying to achieve while being diversified across the board, right? So it will not track the S&P 500 all the time, right? And the S&P 500 is composed of a set of companies where you will see a particular sector pick up, and then maybe some other sectors not perform. So this might not track the S&P 500 exactly, but yeah, the approach here is to give you a consistent outperformance and then do it at a low risk, right? And if you do that consistently over a long term, you will see that suddenly you have outperformed the index by a very fair margin, right? And you've been happy while doing it without taking too much risk.
Got it. In this, there's still not a lot of geography-based bets that are in this West. So are you thinking about something like that in the future, like let's say Europe or China or other country-based bets, or not so much?
So I mean, we have included those geographies in this West as well, but to be honest, those things have not picked up. Those things are not what we think should be allocated to. The algorithm has not allocated to those instruments right now.
Okay.
Yeah.
So the universe has them, but then based on the algorithm, it doesn't sort of recommend that, okay, they should be included.
Yes.
I see. Okay.
Yeah, because these days, like when you are investing into a China ETF or a Europe ETF through the US market, then you tend to get a dollar registered price on it, right? So a European index would be so much, it won't give you a very good result because the European currency is depreciating so much, right?
Correct. I see. Understood. Got it. There are some questions which I'll quickly take a look at and see if we can take any. So Naval has a couple of questions. One is, what should I look beyond tech stocks? I just understand tech. So any thoughts there, Sonam, on what to look at or how to start?
So in the US market, like any market, there's so many other opportunities, right? Tech is not something that works all the time, right? Like in the current scenario, when those stocks have become so overvalued, and going down, the interest rates are rising. There's been a very intense sell-off in some of the tech stocks, and they are facing some pressure. So there's so many other things that you can look at. There is the financial sector, there is oil and gas, there is the utility sector, there is other commodity-linked sector, there is healthcare, and the US market has so many other innovative sectors that we don't have in India. So there is so many other things to look at. You can look at even I love to look at the factor exposure also. In India, we don't get to do that through ETFs, right? Because those ETFs are not liquid. But in the US market, you'll find some very good quality momentum ETFs, value ETFs, dividend ETFs that can be very interesting. So there's so many things to look at, right? Yeah. Tech is not the only thing that we need to focus on.
Got it. And Nikhil has a question in terms of given the current volatility, how often does Right Research aim to rebalance the ETF baskets? Like, for example, consumer staples might perform better than consumer discretionary in a recession. So any thoughts on rebalancing and how you're looking at it?
So we rebalance right now on a monthly frequency only, right? And we tend to look at it on a weekly basis. But what we have observed through doing it over the last 3 years is that changing your allocation very frequently does not help the consumer, right? It does not help the investor, because they are incurring the transaction cost whenever we change it, right? And even on the strategy perspective, it's not the best strategy to actually be changing your allocation on a weekly basis, right? Because when you pick up an opportunity, that opportunity needs time to give you, the potential that it has, right? It takes, once you pick up a stock or an ETF or any theme, it might take a month or 2 months or 3 months to give you the actual potential that you have bet on. It doesn't happen in a week, right? So you cannot keep on churning your allocation weekly. But yeah, if there is an extreme risk that happens in the market, right? Let's say you have a crash of more than 10% within a week, right? Then that's scary. And in those scenarios, we do look at the portfolio again, and we try to switch the allocation to, to match what is happening in the market.
Got it. One question from YouTube is from Arpa, which he's asking, with more and more tech giants starting to lay off resources, do you think it's the right time to start investing in tech stocks? Can things go up from here, or shall I wait for a few more months? I can take a quick stab at it, and you can add sort of. I think it's not necessarily linked to or linked to anything to do with laying off resources. I would not use that as a sort of way to decide whether it's the right time or not, right? I mean, we still don't know how long the impact on tech businesses is going to be. So it's likely that now it's just begun, right? And so it'll take some time for it to still play out. And but as Sonam mentioned earlier, valuation wise, it overall does look attractive, right? So while you might not want to try and time the market and wait, you could at least start doing a regular investment in some tech companies that you might relate to. One thing that I was highly encouraged to do is look for profitable technology companies. I think in this sector, in this entire cycle, what we've seen is unprofitable technology companies have suffered quite a bit, right? And the sustainability of the business, all of that, both in private public markets, has been questionable. So looking at businesses in the tech space that are making decent free cash flow, have profits, I think that would be a sort of a prudent way to look at it. Anything else you might want to add, Sonam?
No, I really agree with you here that you've seen that your Apple and your Microsoft have not done as bad as a Meta or a like the Snapchat, which have not given you a consistent profitability. So yeah, so picking stocks within that basket might be good. And yeah, I think once the rate hike stop, or when the dovishness comes, I think tech will be the place where people will start buying, right? So I do agree that things might start to look better for tech. But again, coming back to the question, I am also a little bit scared about when the company starts firing people, I think the morale sometimes gets impacted. So we have to watch for that also. But we are large organizations, they have lakhs of employees, and they will keep on going, and the performance will obviously depend on the nature of the market.
Yeah. There's another question, which is, how can we create a portfolio in India? We do SIPs to average. So you can do something similar in the US markets as well. You can basically do today on vested as well. You can do recurring investments, and the way it works today is you load a certain amount of money into your brokerage account, and then you can keep doing a weekly, monthly, quarterly investment into, let's say, the right vest or any particular stock or any particular ETF that you want. So you can very much do that. And we will also offer the capability for you to do a SIP directly from your bank account very soon. And so that also becomes available to you. But SIP is always a good way to get going, unless you have any particular thesis. Cool. Sumit has a question. What do you think about including inverse ETFs in the portfolio during such volatile times? Have you looked at inverse ETFs? Sonam, they're these infamous inverse ETFs that a lot of people want.
Yeah, inverse ETFs, I think they are again very tricky, right? Like once you allocate to the inverse ETF, then it is only good for extreme bear market, and otherwise then you have to exit it, or you will exclude it. If you look at a chart of an inverse ETF, it only works in risk scenarios, right? Otherwise, it doesn't do really well. So you have to be very, very proactive in allocating to them, and you have to take a very clear downside bet when you are going for these inverse ETFs. So yeah, if you are doing it as an individual investor, who thinks that things are not looking good in the short term, and I might take a negative bet, then you can go for a inverse yield trade.
Got it. Cool.
Mm.
There's another question. Does Right Research allow trade in the US market? So that's what we've been talking about. They have created a tactical US West, and through that, Right Research allows you to get exposure to the US markets. And
Right.
Naval had a couple of other questions. He was asking about how CPI has marginally gone down. So inflation has marginally gone down, but energy and food inflation is still high. Did you get a chance to sort of look at this in terms of are baskets within inflation still high? And do you think that they would come down sometime soon, or still likely to stay high?
So I think, yeah, so see, that's the whole worry that they have, right? Inflation is, if you try to understand inflation, it is composed of a few things. And some of them are very transitory effects, right? Like when they started pumping in money, so that had a direct inflationary effect, right? And when they stop printing money, then that component goes down. When the commodity prices are high, then that affects when the quality goes down. So that's another component. But the core sticky inflation is when when the food prices are increasing, when there is that's actually trouble in the economy, right? That we are not able to control the prices of day-to-day things. So I think that is in fact a huge worry, which is why nobody in the US Fed will come out and say, "Oh, we have done something and inflation is down now, and our job is done." They want to keep it sustainably down. They are aiming for a 2% inflation, right? And it is a worry, when food prices and things like that are sticky and prices are rising, then that is, I think, trouble for the inflationary environment, and that's why the US Fed will maybe continue to hike rates, at least in the short term, till they see very sustainable effects coming in.
Got it. So still likely. I mean, we're not out of the woods yet. It's still overall inflation hasn't cooled down. Some baskets might have.
Right.
One question from Rajiv is, since we are talking about global, any thoughts on China internet companies listed in the US? In terms of my take on that, it's I mean, there are definitely some interesting ones there, but also the entire US-China dynamic is a overhang on all of these companies for a long time, and so it becomes tricky to say whether you should look at them or altogether avoid them because you don't know what will happen.
Yeah. And even the Chinese government sometimes doesn't support the tech companies, right? So it tends to be a little volatile. But yes, I think China is it's a much popular market compared to India, right? So people do bet on it much more readily. So once you see things getting better for China, then it might make sense for you to bet on that as well.
Okay. There are a couple of ETFs, Rajiv, that are also available, which allow you to get exposure to the overall China market. And that might help versus, let's say, particular Chinese technology companies that you want to invest in. Right? So,
right.
Cool. We'll take a couple of more questions. We are close to our time. One question is, how higher can the asset allocation go for a particular stock? Is there a particular number like that? I think it depends on the strategy, right? It depends on what kind of strategy one is following.
No, I really think that you shouldn't go more than 10-12% in a single stock, right? Because otherwise diversification sort of goes away, right? You are very, very actively betting on one particular stock, and you will have a very high unsystematic risk, right? Like if something goes down with that particular stock, your whole portfolio is in trouble, right? So you should maintain 12 to 15%. In our portfolio, we actually don't need to do that because these are ETFs, these are already very diversified, right? Yeah. But yeah, when you're betting on stocks, then you should keep a cap on it, just so that you are not totally dependent on one particular company in terms of your risk.
Got it. I think one operational related question was, can NRIs invest in this without Indian demat account? So Shadu, yes, you can. Basically, anybody from the world, actually, from anywhere in the world, can open an account and invest in these portfolios as well, in the right portfolio or via vested. So that's very much possible. If you need any help, just reach out to us. Cool. I think I can take one more question. Nikhil has a question, which is Warren Buffett has weighed into petroleum company. Do you believe energy ETFs are near peak already? And the second one is with green renewable energy ETFs holding volatile electric vehicle stocks. Sort of what do you think about traditional versus renewable energy? So overall, any thoughts, Sonam, on energy, particularly as a sector, and then renewable energy as a sector? I think that could help summarize the question.
Yes. So I think the energy stocks have been gaining in the past month or so, right? As the crude prices have started to pick up. And I think, if growth comes back in the economy, right, then there will be demand for these things first, right? You will have the demand for energy, you will have the demand for, logistics, etc. And so I don't have a negative bias towards these stocks. But obviously, if they keep on hiking the rates, then, commodity prices will not continue to go up. They will taper down at a certain point in time. So it's a tricky situation, but we have taken fresh bets in the energy sector recently. So I think it is interesting. Talking about renewable versus non-renewables, I think, renewable is a big bet for the next decade, right? Like, renewable energy is going to take over the next decade, right? You will see a whole pivot happening, and all the big multinational automakers to energy companies have taken that pledge to shift, right? So you are going to see a shift to renewable happen, but it won't happen within the next month or next quarter. So if you're going to take a long-term 10 years bet, then it's perfect to it makes sense to bet on the renewable sector, right? Because you will see that in the next 10 years it will take over, but timing it is different, and I cannot tell you which month or which quarter will it do well, right? The focus will come when these things have a very sharp uprise, and at other times they might continue to be a little volatile, right? So much like the tech sector, how it's been doing, right?
Yeah. The one of the good things about the US markets is that you sort of have an opportunity to bet on these emerging sectors, which doesn't sort of tend to be available in the India markets.
Right? Yeah, and you have large cap stocks to chase over there, right? It's not like there's a small tiny company in India that's doing it, or a fresh company which has no history. You have these large companies that have done it consistently, right? So you have a opportunity to bet on a lot of interesting themes in the US market.
Correct. Very volatile, but not for the faint-hearted. But then, if you're looking long-term, then it's definitely interesting.
Yes, I mean, it does have that alpha, right? We've done a lot of research on ESG in my previous roles, and it does have incremental alpha over the market. ESG does give you outperformance, but yeah, timing it is tricky, right? Timing is a difficult thing.
Yeah. Great. Okay. I think that brings us to the end of this session. We've taken enough of Sonam's time. Thank you. Thanks everybody for listening in, and big thank you to Sonam again for coming by and answering all of these different questions, giving us a perspective on what's happening in the US markets, about the right tactical vest, the thinking behind it, why you're looking at different ETFs, looking at the rebalancing monthly, and then overall your thoughts on different sectors. So thanks again everybody for taking the time out, and thank you.
Yeah, thank you, Viram, for having me. I had a great time. Thank you, everyone.